Market cycles and economic forces. Nothing in the market ever stays still. Prices rise, prices fall. Booms turn to bust, and from those ashes, new opportunities are born. The stock market, like the economy itself, moves in a cycle. Wave of optimism, expansion, panic, and renewal that repeat again and again through history. To understand these cycles is to understand the heartbeat of capitalism itself. The nature of market cycles. A market cycle is simply the natural rise and fall of prices and economic activity over the time. And while no two cycles are ever exactly the same, they tend to follow a familiar rhythm. It starts with expansion, confidence grows, companies invest, jobs multiply. Then comes the peak. Optimism turns into euphoria and speculation runs wild. Next is contraction. Prices fall, spending slows, fear spreads. And finally, the trough. The bottom where despair peaks but recovery quietly begins. Just like the seasons, these cycles are inevitable. They are not a sign of failure, they are part of renewal. The economic engine. Behind every market cycle lies the bigger force, the economy itself, a massive interconnected engine powered by production, spending, and credit. When people feel confident, they spend more. Businesses hire, expand, borrow, and build. Bank lend easily and money flows freely. But when uncertainty grows, that same engine starts to slow. Consumers save, businesses cut back, lending tightens. Growth gives way to contraction. And right at the center of it all sits central bank like the US Federal Reserve. Their job is to keep that engine balanced, not too hot, not too cold, using tools like interest rates and the money supply. The role of interest rates. Interest rates might look like small numbers, but they have massive power. When central banks lower rates, borrowing gets cheaper. Businesses expand, consumers spend, and markets rise. But when inflation starts running too hot, banks raise rates, cooling the economy, slowing borrowing, and often pulling markets down. It's a balancing act. Push too hard and you risk a recession. Hold back too long and inflation takes off. Every major boom and bust in modern history has been influenced, at least in part, by changing in interest rates. The anatomy of a boom. Every bull market, every stretch of rising prices starts quietly. Confidence creeps back after a downturn. Investors begins to believe again. As profit grow, optimism spreads. The headlines turn positive. People say the market's unstoppable. Soon, speculations take over. Investors pay for what they hope companies will earn, not what they are earning now. And that's the danger zone. When rational analysis fades and excitement takes over, booms always feel endless until they are not. The breaking point. Every boom carries the seeds of its own destruction. Too much optimism leads to overvaluation, debt piles up, and then a shock hits. Maybe a weak earning report, maybe a rate hike, maybe a political crisis. Confidence setters. Investor rush to sell. And the same emotion that once pushed prices too high now drags them too low. Panic spreads faster than reason. And just like that, the market shifts into its next phase, the burst. The downturn and recovery. During downturns, fear takes over, jobs are lost, portfolios shrink, news outlets predict collapse. But even in the darkest moment, the system starts to heal. Weak companies fail, strong ones adapt, cost fall, innovation rises, and new opportunities appear. History shows that every market collapse has eventually been followed by recovery. After 1929 came decades of industrial growth. After 2008 came the longest bull market in the US history. Pain gives birth to progress. Real world examples of market cycles. Let's look at the sum of big ones. The Great Depression 1929 to 1939, triggered by speculation and a weak banking system, it reshaped the global economy and led to regulations that still protect investors today. The dot-com boom 1995 to 2000, fueled by the excitement around the internet, stock prices shot beyond reason until profits failed to show. The crash wiped out trillions, but from its ashes rose giants like Amazon and Google. The global financial crisis 2008, housing speculation and risky lending brought global finance to its knees. Markets crashed, economy froze, but the recovery that followed, helped by low interest rates and innovation, changed finance forever. The pandemic crash 2020, when the world shut down overnight, markets went into free fall, but within months, stimulus and digital transformation sparked one of the fastest recoveries in history. Each of these cycles left scars but also lessons, and those lessons shape how we approach the next one. The long term view. Zoom out far enough, and all those market ups and downs smooth into one undeniable trend growth. Despite wars, recessions, and crises, global markets have moved upward over the long run. Why? Because human progress never stops. We innovate, we rebuild, we reinvent. In short term, markets are ruled by emotion, but in the long term they are ruled by the productivity and innovation. That's why patient investors, the ones who ride out the storm, usually come out ahead. Predicting the unpredictable. Can we predict the next cycle? Honestly, not perfectly. Economists use all kinds of models tracking GDP, inflation, employment, and rates, but no one can predict human emotion. The best investors don't try to time the market, they prepare for it. They diversify, they stay informed, and they stay calm. When everyone else panics, the question is not if another downturn will come, it's when. And when it does, those who are disciplined and patient will be ready. Markets move in cycles: expansion and contraction, greed and fear, despair and hope. To some, it looks chaotic, but to the wise, it's opportunity. Every downturn carries a lesson, every recovery carries a reward. Together, they form the rhythm of progress, a rhythm that has guided humanity for centuries. And in the next chapter, we will talk about how to invest wisely, strategies to navigate these cycles, manage risk, and build lasting wealth in an ever changing market.